AI mania is fueling bubble fears. Our market's partying like it's 1999. Stock market bears are growling again, warning of a new tech bubble. As US equities hit record highs, investors are still eager to ride the rally, but wary of history repeating itself. Tech isn't nearly as frothy as it was before the dot-com crash, yet risks are rising. So is this the next leg of the boom or the calm before the bust? Harry Eastwood is investment director at Artemis Investment Management. So Harry, AI-related stocks have driven roughly 75% of S&P 500 returns since 2022. Are bubble warnings lights flashing for you?
I think the natural connection, as you kind of suggested, is looking back at the telecoms boom. But actually, when you look at valuations today of the largest index constituents, they're certainly not as elevated as we saw 25 years ago. I think in combination with that, these are some of the most profitable businesses, around the globe, and to a degree, that valuation premium that they are trading at is supported by that, really attractive fundamental picture.
Well, history does show that investors can profit from bubbles. So how can investors protect their portfolios without trying to call the peak too early?
It's really a case of diversification, in my view. I think, having that US allocation to those AI beneficiaries, but really bolstering it or ballasting that exposure with other more attractively valued areas of the market. I think there's some really interesting parts of Europe that have been depressed for quite some time. I think there's really interesting parts of emerging markets, in particular China, that work quite well in terms of that asset allocation.
Well, let's look closer at China. It's vowed to boost tech self-reliance over the next 5 years. Could it now become a hedge if Wall Street's AI enthusiasm fades?
I think so. And I think it comes back to that point I made earlier. I think valuations are much lower than their US counterparts, particularly in the kind of tech universe. I also think that if you look at some of the government kind of stimulus measures and policy measures that are happening in China in terms of that anti-involution campaign, in terms of some of those more pro-shareholder policies that they're encouraging, I think that should be supportive to earnings, alongside those tailwinds that you should get from the integration of AI within the companies based in China.
There has been a frenzy of AI on AI deal making as well, but the same big players keep dominating. Is this concentration risk dangerous, or are they too cash rich to fail?
My view is that there's a requirement and a kind of necessity to build out compute power to deal with this kind of optimism around AI, but also a realization that we are at really the foothills of what is a technology revolution. I think these deals are necessary, and I don't yet see them as a cause for concern.
Let's turn to the banking worries, though, and global credit markets wobbled last week after a few loan blow-ups rekindled memories of the 2023 regional banking crisis. Are these isolated flare-ups or a warning of deeper stress?
I think what you'll find is businesses perhaps taking a closer look at some of the lending that they've done. You might hear, as we move forward, more examples of fraud as that process of carrying out additional due diligence kind of plays out. But if you look to, let's say, regional banks in the US, I think actually, their loans are backed up by, pretty good collateral. I think they're in a relatively healthy kind of position from a balance sheet perspective. You've got rates declining in the US, which should be supportive to those areas of the market. So, there are risks that I think warrant further investigation, but more broadly, I think the banking sector is certainly not necessarily in poor shape.
So finally, Harry, Wall Street strategists have kept raising their forecasts as the S&P 500 powers higher. Does this rally still have room to run, or are we setting up for a fall as we head into the new year?
I think it really hinges on two things. One is whether AI can continue to deliver, and people's optimism around AI can kind of be sustained. Another thing is maybe to monitor whether we start to see kind of more signs of tariff impacts feeding into companies' earnings. I know we're going into and are partway through Q3 earnings. It's been, pretty good so far. That should support that premium valuation in the US market and also drive share prices higher. But I definitely think, investors are starting to get a bit more nervous after we had, what was a fairly sort of Goldilocks summer.
That was Harry Eastwood from Artemis Investment Management. Don't forget, you can watch more videos on Reuters.com.